On-chain currencies always raise a lot of fundamental questions about utility, about governance, and about their general structure. Our next panel, titled Euros on-chain, Roles, Use Cases, and Guardrails, moderated by VIA Science's Daniela Boback, will bring clarity into exactly these fundamental questions. Please give it up for Daniela Boback and her panelists. The microphones are turned on. The stage is yours. Hey, Patrick.
Thank you very much, Marcel. So, the euro is increasingly appearing in blockchain-based financial systems through stablecoins, tokenized assets, and emerging payment infrastructure. This raises a fundamental question. If euros move on-chain, who actually operates the system and what roles will different actors play? Like Marcel said, I'm Daniela Boback. I'm Head of Business Development and Ecosystem at the German Blockchain Association, actually. That's the head I'm having right now, called Blockchain Bundesverband e.V., and I have the pleasure to moderate this amazing panel. And before we dive deeper into this, I would ask my panelists to briefly introduce themselves, and I would say, Patrick, maybe you give it a first start, please.
Thanks, Daniela, and hi, everyone. Can you hear me okay?
Yes.
Okay, perfect. So sorry to not be able to join you on stage. Would have loved to come, but unfortunately an emergency stopped me. Hopefully next year I'm back in Frankfurt. So hi, everyone. My name is Patrick Hansen. I'm Director for EU Strategy and Policy at Circle. Circle, for those who don't know, is a global financial technology company, primarily known to be the largest regulated stablecoin issuer in the world. So we issue the largest regulated dollar token, USDC, the largest euro-denominated stablecoin called EuroC, and also the largest tokenized money market fund, USYC, out of our regulated entities. I particularly look over our strategy, our regulatory setup, and our expansion in Europe, and I'm looking forward to discussing all of these interesting topics with you guys.
Thank you. Tony, maybe you as well.
Hi there. My name is Tony McLaughlin. I am the CEO of a company called Ubyx, and we are a clearing system for tokenized money, which perhaps I will explain later.
My name is Alexander Brunner. I'm a senior advisor of VIA Science. VIA Science is a US-based Web3 data security company. Originally, they developed a Web3 infrastructure that has military-grade capabilities for data security for the US Navy, US Air Force. So no crypto initially. Since end of last year, we integrated payment functionality of stablecoins. Our first partner is Circle, so happy to see you, Patrick. And we're working on Stellar. And I'm based in Switzerland. I'm overseeing the European market. And I'll be a bit sharing a few thoughts how Americans are approaching the topic of stablecoins versus maybe the European approach.
Hi, Jan Sell, CEO of Qivalis. We are building an EMI out of Holland, which will issue a euro stablecoin and is backed by a consortium of European banks, including the likes of ING, UniCredit, BBVA, BNP Paribas, and so on. And I might give a European perspective on how we build a stablecoin and why.
Thank you very much. So let's start with a question for every one of you. Maybe an easy one, maybe not, I don't know, you will tell. Do we need euros on chain, actually?
Well, I guess I can start with that. I would say, I mean, if we are talking about the blockchain basically provides a number of efficiencies around pretty much any business process that involves two or more parties that don't trust each other. And if you look at financial processes that can be improved with being put on chain, like for example cross-border payments or treasury management operations and so on, there are a number of efficiencies there which can only be captured on chain at the moment, given the way the technology is going. And if you sort of want to capture those efficiencies in financial markets, you need a euro there if you're operating in euros. In fact, I mean, it plays into longer or the bigger narrative about European strategic autonomy as well. But maybe we can get into that later on.
Okay, and what is your take on that? Are we solving a real market demand with that, or are we still building infrastructure ahead of adoption?
Can I try to take part
Please.
1 and part 2 at the same time? So I think a first principles argument is that a blockchain is a venue for commerce in the same way that a high street or a physical marketplace is a venue for commerce. And if people who transact on those venues don't have access to regulated money, then they will still transact, but they will transact in unregulated money. So our sovereign currencies have to occupy the spaces that people want to do business. They want to do business on the high street. They want to do business in a physical marketplace. They want to do business on Ethereum. And so we must provide regulated financial services to these venues for commerce. Otherwise, we create a tremendous vacuum. And unfortunately, that's what we've done. Through an abundance of caution, we have inhibited regulated financial players entering these spaces, and that's created oxygen for unregulated finance to flourish. So I would say whether it's about sovereignty, whether it's about the regulatory perimeter, it's an obligation to enable regulated finance to transact on these new venues.
And would you also confirm that it also have to be in euro? Because, I mean, we have lots of US dollar on chain already.
Absolutely, because European citizens should have the right to transact in euro if it's their choice. So if the regulated instruments are not provided on these venues, then don't be surprised if someone transacts in Tether if they haven't got access to regulated euros. That's not the fault of the person doing the transaction. They want to conduct a financial transaction and they're using whatever is available. So the market failure is if regulated financial services does not turn up on blockchains. That's the market failure.
I think I would just add to that. If you look at on-chain stablecoin transactions at the moment, I think I saw a study recently that put the number of European transactions at about 36%. At the moment, those are all happening in US dollars, or those all minus the 0.2% that is in euros at the moment. So there's obviously a need.
Maybe I'll try to answer from a more practical term. If you think, when was the last time you used stablecoin to buy anything in Frankfurt? Have you used anything? I'm sure there's no one in here has used stablecoin so far. So Europe, so far, I'm not sure if there's a need for European stablecoins by common people or the normal citizen. Stablecoin has been used in crypto trading mostly. I'm sure Patrick Hans will address that a bit more closely. But what we've now been seeing, and we just did last year, a pilot in Haiti where we've been paying out through stablecoins to mothers in need, and now also to the staff on site through stablecoins, because it's much better than using cash and shipping physical bills. So the reality in emerging markets where you have a much larger unbanked community, there it is real. And they, on top, like US dollar, I think the driver, what we've been seeing so far is a lack of a good enough banking infrastructure helps with adoption. And obviously, if you have inflation or an unstable local currency, the US dollar is an attractive alternative. And that could potentially be for the euro as well. But I think a lot of the adoption we'll probably be seeing, and I'm happy to talk about what we're seeing now coming from the US, I think in emerging markets will be the battleground for stablecoins in a retail space. I'm not talking about CBDCs.
Okay, thank you very much for adding this. If we imagine an on-chain euro ecosystem, we could think of it as a stack. The form of money itself, settlement infrastructure, and financial market integration. Patrick, this is a question for you. Stablecoins have already become the settlement asset of crypto markets, right? Do you see regulated euro stablecoins playing the same role for tokenized financial markets in Europe?
I think so. I mean, only time will tell after all, right? But I think we're heading there. We really believe that ultimately, currently, this entire industry, including us and the other panelists, are building a new internet financial system. And if we succeed, we fully believe that capital markets, including traditional capital markets, will come on chain. How will that look like in detail will depend on market factors, regulatory developments. We see encouraging signs for now, including in Europe. I mean, you have those DLT pilot regimes, for example, where tokenized securities are already settled on chain against euro stablecoins. We're supporting some of these teams, right? And already today you can buy, for example, a tokenized money market fund and settle with EuroC, our euro-denominated stablecoin. That is not happening at scale though yet. And there are some also regulatory developments, clarifications that will be able to enable that at scale. Currently, there's the markets integration package being discussed at the EU level. And we still do think there are some barriers for euro stablecoin settlement in the it's quite technical, but in the CSDR, so the Central Securities Depository Regulation. And also, we believe that currently there's not enough clarity in order to be able to use e-money tokens as collateral in some of these capital markets. So I think the market first has to come on chain. We need to see the liquidity there. Some of these regulatory barriers need to be removed. But ultimately, I do think that e-money tokens will be the preferred model here for the majority of the market. There will be other tools, deposits, maybe on-chain CBDCs as well. But I think for the large majority of the market, stablecoins will be the preferred choice. And I actually think it's a great sign that Jan and team are building an e-money token with the bank consortia behind and not necessarily a tokenized deposit. I think that's a strong backing of e-money tokens as the future of settlement.
So thank you very much. You have also answered my second question actually right away. I would just jump to Tony then. Many people argue that stablecoin ecosystem risks become fragmented across issuers and blockchains. I think you have taken a different position there, right? Can you explain why you believe fragmentation may not actually be the long-term outcome for stablecoins? And where does Ubyx come into play, if they come into play there?
Okay, it's a bit of a softball question, but I'll ignore the opportunity to sell my company. I won't do that. Look, back end of the 1960s, credit cards were invented, and they replaced store cards. So previously there was store credit, which is a special purpose way of accessing credit in one department store. And then credit cards were invented, and that's a more general purpose way of accessing credit that can then be used on multiple stores. But believe it or not, there was a time when there were only a couple of credit cards, and they were US dollar credit cards. Now just imagine we're back in the late 1960s, and people are observing that market structure. They might say things like, wow, there's a power law that means there's going to be only a couple of credit card issuers, and everyone in the world is going to use dollar credit cards. Now, that was ridiculous. That's ridiculous with hindsight, and it's ridiculous when people say that thing about the same thing about stablecoins. So we live today in a world of there are 16,000 card issuers, and there is zero fragmentation. You can go with your Deutsche Bank credit card to New York and shop in Macy's, and Macy's doesn't give a damn about Deutsche Bank's balance sheet. Someone from the US can travel to Malaysia and stay in a hotel, and the Malaysian hotel doesn't give a damn about the issuer's balance sheet. So the truth of it is that we've seen this movie before, and here's what's going to happen. You can, the world will turn, the clock will turn, and you can test this thesis. We're going to have a many-to-many market structure. There will be many issuers of tokenized money. That tokenized money, there will be stable coins, and there will be tokenized deposits. There will be tokenized money market funds. There will be many issuers. The issuer needs acceptance, and the issuer cannot build its own acceptance network. There will be a mutualized acceptance network. In the history of payments, Here's the example. Circle have Circle Payments Network. This is American Express. One issuer building a proprietary payments network. The alternative model is Visa and MasterCard, which links together many issuers and many acceptors. My company is the new Visa for tokenized money, which links together many issuers and many accepting parties, so that Qivalis does not have to knock on the door of an African PSP to get acceptance. That would be a ridiculous thing for Qivalis to do. So here's what's going to happen. There will be a many-to-many network. There will be a mutualized acceptance network. And every bank and fintech on the planet will offer a wallet. And that will be a pluralistic market structure with many currencies, many issuers, and there will be thousands and thousands of issuers of tokenized money and zero fragmentation. Is that controversial enough?
That's a very good answer,
Bombshell.
I would say. Thank you very much for this. I would have another one for you. You also described stablecoins as potentially functioning like negotiable instruments in the financial system. Is that correct? What would that mean in practice for how they circulate between institutions?
Can you ask somebody else a question? Because I was just talking there for like 10 minutes.
No, but you're doing really well. The others are having their time. Trust me for that. That's my job.
So again, there's nothing new under the sun. If I'm an issuer of a promise to pay, if someone in the audience gives me 10 euros and I write a piece of paper, I owe you 10 euros. That piece of paper can start being traded in the room. It can be negotiated. Or someone can come back to me, I'm the issuer, and they can claim the money. So if I write, I owe you $10 or 10 euros on a piece of paper, or I inscribe it on a block of marble, or I write it in a relational database, or I put it as a token on a blockchain, its fundamental nature hasn't changed. It still means I owe you 10 euros. USDC is I owe you 10 euros on a blockchain. But it's not fundamentally different than to be written on a piece of paper in terms of its its platonic reality, in terms of its like idealistic reality. So it just so happens that in the history of humanity, we've had many turns of the wheel of technology. We had paper, we had relational databases, we've had checks, we've had credit cards. They all exhibit the same market structure. Many issuers, many redemption agents. Now here's the lesson to learn with stablecoins, because people treat stablecoins as if oh my God, we've never seen these things before. Here's the lesson. Stablecoins can be processed exactly like checks. You should be able to this is something you can't do today, which would make the market structure infinitely better. You can't take a stablecoin to your bank and deposit it into your bank account directly like a check. When that happens, the stablecoin market structure gets much better because the bank or the fintech acts as a KYC provider of a wallet and converts the stablecoin into cash. So the way that Qivalis and Circle and everyone the way that this thing happens is when every bank and fintech offers a wallet, and you can receive any stablecoin into your bank wallet, and your bank credits your account. And this isn't science fiction. This is checks. So all I'm asking for, or all I'm suggesting, is that we take this 21st century technology and make it equivalent to 19th century technology. It's not a hard ask.
I like that. Jan, do you want to add anything? On the other hand side, I have another question for you.
Well, I mean, that's partly exactly what we're building on the Qivalis side, right? We have a consortium that's an open consortium. We have at the moment 12 banks, and the number of banks is growing. And many of those banks will end up also providing access to the token via via their own bank accounts and via their bank accounts for their clients. So it will hopefully end up in exactly that scenario.
Well, it wouldn't end up like that if those banks only accepted Qivalis tokens. The way of that would be trying to create a closed loop. The real way to get hyper growth is on the accepting side. In Visa rules, there's a rule called accept all tokens. So the real way of doing it is that your tokens can be accepted by any bank, and your member banks can accept any other token. Otherwise, that is a way of creating walled gardens.
Yeah, I mean, we're definitely not aiming to create a walled garden. We're simply building the infrastructure to put the euro on chain, but being built from inside Europe. So I guess the difference being to Circle, and looking to use the network of banks we have in the background to make that token more and more usable and used across Europe and across the world, really, because in the end, everywhere where the blockchain is used for financial transactions and where the euro is used for financial transactions, we want to build that bridge, that interface between the euro and the blockchain.
So will markets converge around one form of digital money then, or will we see stablecoins, tokenized bank deposits, and CBDC coexisting?
Well, I think if we were talking about the euro, for example, I think we see it as all part of the same kind of financial stack. I think Marike will go into detail in this later on one of the later panels. But in short, I think at the moment what we have in Europe is the ECB building a digital euro on the retail side, which you can think of as kind of floating on top of the stack, and then you have wholesale CBDC at the bottom, where you'll have wholesale banks will have access and use that as a settlement layer, but neither of those are currently at least envisaged to be on-chain, right? There will be a different form of ledger. And so in between the two, there's a gap, which will be filled by stablecoins on the one hand as a payment token, and then tokenized deposits or tokenized money market funds more on the yield side, most likely. But so it's a kind of, I think it's a monetary stack that all interoperates and will interoperate.
Thank you for this answer. Maybe a question for all of you. If we look to the US, regulators are increasingly starting to treat stablecoins more like financial assets, for example, allowing broker-dealers to treat them as regulatory capital. Does that support your thesis that stablecoins are becoming part of the core financial plumbing?
Yes. Stablecoins shouldn't be Frankenstein monster money. They should be normal money, and that means cash equivalent. And cash equivalence means you should be able to convert it at par value into other forms of currency. And the economists love this term, which is singleness of money. Singleness of money means the issuer doesn't matter. So we have to get to a place where the issuer doesn't matter from the purposes of the receiver. Again, this is exactly what we've achieved in cards. When you take your Deutsche Bank into Macy's in New York, they don't care about Deutsche Bank. So there's a lot of focus on issuers at the moment and the regulation of the issuers. But the end result is cash equivalent stablecoins where the issuer doesn't matter for acceptance.
Thank you very much. Let's have a look on the infrastructure and real-world integration side. Digital money alone does not change financial systems unless it integrates into real operational environments. Treasury, liquidity, corporate finance. Alexander, a question for you. From the infrastructure and systems perspective, obviously, what still needs to happen before companies and financial institutions can realistically integrate on-chain finance into their operations?
That sounds like more a question for Tony or Jan to answer, but maybe I'm just going to try to change a bit at altitude and see where adoption is. I think I've been listening to a lot of panels this morning, and there's a lot of clever people talking lots of things about, central banks, about how to integrate it and risk, and a lot of integration and fragmentation skills. The question is always, where's the adoption? That's sort of my first comment I made. And I can't help feeling sometimes that there's limited enthusiasm in Europe for stablecoin adoption on multiple levels. I sometimes feel, maybe Jan, you can contradict me, the banks are doing it somehow, but with lesser enthusiasm. And I'd like to contrast that with the US. And I think what we see is this, the current administration has realized that there's geostrategic power to stablecoins. If you listen to Trump in the first administration, he didn't like Bitcoin. He said there's only one beautiful currency, it's the US dollar. And now under Scott Bessent, they realized, hey, stablecoins are basically an extension of US dollars. And it has another benefit for the US. You can refinance your debt, because Circle, I think, has become one of the biggest treasury or money market funds in the world based on that. So there's a clear interest from the government and administration to push stablecoins. And without being able to share too many details, but if you think where Americans see opportunities when it comes to stablecoins, we see, when you listen to the administration, you see multiple level of initiatives. First, they're still running a global network of bases, of military bases that are mostly run in the cash infrastructure world. They clearly see opportunities moving that into stablecoins. If they do that, you would have global adoption through 300 plus bases in a single instance. That's one approach. The other thing is the US Treasury, and that's one thing you saw, is like with US aid, they're highly critical, or they think there's a lot of corruption in the system, the way the donation work, the humanitarian aid works. They're really looking into that. How can we use stablecoins? So coming from more the adoption side, I think what America has realized, and sort of maybe Europe has not, is that this could become a new form of money we've known before in a new shape and form, but making it programmable and more traceable adds benefits if you want to control your money flows. And I think from a geostrategic approach, and I think watch this space the next couple of months, you'll see some major announcement from the US government how they're going to enforce stablecoins. And maybe just the last observation, and sort of alluding to your question that I can't really answer. I'm a former banker, but I think Europeans get caught up in the questions: what type of stablecoin is it? How we can integrate it? How can we license it? What kind of regulatory framework? I've heard this a dozen times this morning. Once the regulatory framework is more clear, we're going to move faster. I think this is all just saying we don't really know, because we don't really have a clear strategy as Europe from that. I'm telling you, America has a very clear plan. And I think once they start transacting, there'll be surprises on the European side how fast it will happen. And maybe just a last observation, because often we're comparing ourselves to the US, is when you look at what has China built in recent years, they have, I strongly suggest everyone to look up, there's a Forbes article about the global end payment treasury system. It runs fully on blockchain. It has trillions of transactions of yuan every day. The whole WePay is now at the backbone, cross-border payments on blockchain. So all the things that Europeans are often thinking or talking about actually have been built and are being built. And as I think the question going forward is, where in this geostrategic landscape does a euro stablecoin fit in, and what does Europeans want to do with it? Is it something between banks or the cash leg of tokenization and all that? And I think this will force Europeans to reconsider in a short time how to move. And I've been talking to some of the community here, and everyone is hoping, actually, one of the things I've heard is like, we hope that America moves, then Europe will move too. So let's see if that's the go-to-market approach.
Well, I'd like to just jump in on the comment about the banks, because obviously we're quite close to the 12 that we're working with, and that's an increasing number that we're talking to say actually there is quite a lot of movement there. There's quite a lot of interest. We're working with each of the banks also bilaterally to try to help them work out how they use stablecoins, because they're all at different stages in their digital assets journey. But some of them are quite advanced and have quite advanced thinking about what kind of use cases they would use the stablecoin for. But in the end, it's going to be an open stablecoin that will be used by, like I said earlier, by anyone who uses the euro. And from a geopolitical perspective, right? If you look at financial flows of the euro in the fiat world, it makes up about 20 to 25% of global cross-border payments, of global reserves held, of bond issuance globally. But in the stablecoin space, it's 0.2%. So there's a major delta there, which I think we need stablecoins from Europe, in Europe, euro that will to fill. And I think that they will happen and it'll come. I'm definitely less bearish on Europe than you are.
Thank you very much for adding this. So that's today's reality, institutions and corporates, and Alex just mentioned it already, but we're also seeing new types of users emerging. Patrick, this is a question for you again. Stablecoins are increasingly used by NGOs and foundations. At the same time, we're seeing agentic AI entering finance. How do these trends come together? What is your opinion on that?
I mean, they're quite different things, right? So NGOs, AI, completely separate topics here. The only thing that I would mention is they ultimately use or choose stablecoins is due to just the infrastructure benefits that stablecoins offer, right? And I think that has been discussed here. It's a global, cross-border, digital, programmable infrastructure. NGOs might, and we have had pilot projects with some of these large humanitarian organizations. They might choose it because it works cross-border, instantly, digitally, right? And AI agents might essentially flock towards stablecoins because they are 24/7 programmable, programmable money. And ultimately, I think that's where the value proposition comes from. And maybe to the earlier discussions of euros and dollars and currencies, I think that as we think about in the internet financial system coming on chain, ultimately, be it NGOs, be it corporations, financial institutions, they will rely on a wide array of currencies and blockchains. So the same way that the corporate treasurer here in Frankfurt, where you all are, uses dollars to pay some suppliers, whatever in the US, uses pounds to pay suppliers in the UK. The same way, I think a future on-chain corporate treasurer will use the euro to some extent for some transfers, will use the dollar to pay other suppliers, right? And so I think that's an important thing to keep in mind, especially in Europe, where the narrative around, we should build guardrails around foreign currency, stablecoins, etc., is very strong. I think we should all keep in mind that what we're building is a global infrastructure here with globally liquid and accessible currencies. And I think the key that will also build strong euro stablecoins is actually integrate with these globally liquid, globally accessible markets and not the other way around. I personally do not see any future where we will get strong euro stablecoins without being heavily integrated with these globally liquid, accessible on-chain markets. And that's the first step, I think, for euro stablecoins and European projects to grow, is tighter integration into these global flows.
Thank you very much. So you have built already a beautiful bridge to the next topic, digital sovereignty and ecosystem structure. We may end up with several forms of digital euros at the same time. That's my take on that at the moment. Stablecoins, tokenized bank deposits, CBMT, we have heard that phrase before. Potentially a digital euro as CBDC. How important is digital sovereignty when building the euro's on-chain ecosystem? Do you expect this ecosystem to evolve through collaborative infrastructure between different actors and countries? Or could we eventually see winner takes most dynamics similar to other digital platforms? That's a question for all of you.
Can I give it a go?
Of course.
I agree with your comments that it starts with strategy. It starts with strategy for, the difference between what America is doing and what we tend to do in Europe is America is acting out of national interest, and it's not dumb to diversify demand for US treasuries through stablecoins. So humbly, I suggest to you, here might be the components of a strategy for Europe which are in sovereign interest. Part one, banks and fintechs in Europe, there are 5,000 of them. They should offer wallets to their customers so that the foreign stablecoins coming into Europe are captured in our banks and fintechs. Those banks and fintechs should convert those dollar stablecoins into euros, moving the money from the American balance sheet into the European balance sheet. This is point number one. Now, when every bank and fintech in Europe has a wallet for catching the American stablecoins, wow, the same wallets can be used for euro stablecoins. And so then we have an acceptance network in Europe for any kind of euro stablecoins to be circulated. So this is point number 2, which is we have a universal wallet acceptance network in Europe. The third point is we can play the same game as the Americans. Qivalis tokens should be accepted by our export part, by the people that we're importing from. So my t-shirt, my shirt probably is made in Vietnam. I didn't buy it, it's not an Italian shirt, okay? The importer should be able to pay for this t-shirt, for this shirt, with the Qivalis euro token. And then imagine you're in the predicament of the exporter in Vietnam. You've now got a Qivalis euro token. Well, that exporter might well want hard currency in portable format and something which is not dollars, because maybe I want to be diversified against the dollar. But that exporter in Vietnam needs to be able to turn that into Vietnamese dong whenever they want to. So the other point there is that we need to build global acceptance for Qivalis stablecoins. How do we do that? Well, we have the believe it or not, the raw material already exists. So I don't know, Manuel Klein was here before from Deutsche Bank. Deutsche Bank provides euro accounts to hundreds and hundreds and hundreds of foreign correspondent banks, including banks in Vietnam. There's no problem with a Vietnamese bank accepting a euro stablecoin because it can be cleared through Deutsche Bank. And by the way, that Vietnamese bank will love to accept the Qivalis token because when they convert it from euros into Vietnamese dong, they will make FX. So if we want to win the stablecoin game, 3 components: catch the foreign stablecoins into bank and fintech wallets, convert them into euros, have a universal acceptance network in Europe of wallets provided by banks and fintechs, and build a global acceptance network for euro tokenized money.
That sounds like a strategy, I would say. I hope all the right people are listening right now. Do you want to add something? Yes,
maybe just, it seems your strategy is perfectly thought out. I really love listening to you. And maybe I'm just going to take a step further into adoption. I think what we've been seeing, and also VIA is backed by Bosch and BMW, and one of the discussions we're having, and it's unfortunately still a bit of a discussion, is in this new world where we have much more autonomous vehicles. I'm not even talking about agentic AI, but literally autonomous vehicles. Obviously, in-car payments, making payments payable through charging, and would be a perfect use case for stablecoins because you have programmability features. Well, you can have different, subscriber modes for even for parking. So there's a lot of that, and there's a lot of general interest and thoughtfulness about that. But I think that would be one of the things, if Europe sees this as an opportunity to say, hey, we're shipping those cars worldwide, we're going to equip them with wallets, we have this upcoming EU ID wallet, we integrate that and we try to create adoption. What I have to say, and maybe to your point, the Americans are always thinking about adoption and distribution first, because that's where money's going to generate it. And here the discussion is often what's the regulatory correct framework and structure and infrastructure. And the Europeans love talking about that for hours. While the Americans will say, hey, how can we make use cases? I'm telling you, there are use cases coming out of the US Department of War and Treasury in the futures. And Europe should be thinking, where are our strengths? How can we embed, and to your point with Vietnamese banks, and having wallets as part of the future flows we have, and maybe even as a counter or an alternative to the MasterCard Visa payment, but unfortunately I have to say this geostrategic thinking is sometimes a bit lacking in Europe, and we have components where we could add this in and have real clout and market forces, and that would be a way of creating adoption.
Thank you very much.
If I might just add a couple of sentences here, what I sometimes find in Europe, especially on panels and in other fora, is that people think that stablecoin adoption could kind of be forced top down to merchants, to institutions, to holders. And what we have been seeing, or what I have been seeing also following our euro-denominated stablecoin now for a few years, is that the most important ingredient to stablecoin growth and adoption and also to the later fact that some merchants around the world will accept it, that fintechs and neobanks will build integration and wallets for it, is usage and liquidity. And this is something that requires really bottom-up, nitty-gritty work with the players that actually use and transact with stablecoins today, right? Not in 5 years, but today. Even if you look at the largest financial institutions, they want to build rails for the stablecoins that are actually being used. And so look at Mika, right? We have now 20 issuers, we have over 20 euro stablecoins. But why aren't most neobanks, banks, etc. building rails for these? Because not many people use it. And that's why we have taken the approach for EuroC as one example, to go where the users and the holders actually are and build them and try to build the most liquid, accessible, and interoperable euro product. So we're talking to the different DeFi platforms, to the different CeFi exchanges. And by now we're seeing some growth. It has worked, right? EuroC has grown 10x since our Mika announcement 1.5 years ago. And it is now already the most widely accessible euro stablecoin. But what I sometimes miss in the European discussion is they're trying to build the market the other way around, essentially top down. But you have to build it really from the bottom up, where users are today and where the demand is today. And that will lead to institutional adoption later on, in my opinion.
Thank you very much for adding this, Patrick. Unfortunately, we are already out of time. So there was a lot of experience and expertise here on stage and virtually. So thank you very much to all of you. It was really insightful, I would say. And I would ask the audience to please give a round of applause to our wonderful panelists.
Thank you, Daniela.